Happy Canada Day, everybody. It is July the 1st, and we are going to be doing a market update for the month of June for the Guelph real estate market. We're going to be doing a couple of things because it was a huge month in the month of June. Lots of stuff happened. Back on June 7th, we had the Bank of Canada raising interest rates. Then we had a report on June 27th that showed that inflation went down to its lowest point in 2 years. However, apparently that's not going to be enough to stop the bank from increasing interest rates. So there's a whole bunch of stuff to unpack here. We're going to do that all. We're going to get caught up and then kind of give you a predictive quality of what's going to be happening in the future of the real estate market. So sit back and relax and enjoy this market update. I got my coffee ready to go. Let's have some fun and see what's going on. All right, let's go. All right, so let's kick off with the macroeconomic viewpoint of things. And there was a lot to cover in the since we met last. So I wrote it all down here to kind of explain a couple different things and why certain things are the way they are. So for example, on May 16th, April inflation numbers came out at 4.4%. And I'm just going to show you on a graph what that looks like here. Here's the key inflation numbers. We've been coming down since June from 8% all the way down, really positive trend. And we had this little blip here at 4.4%, and then we dropped down to 3.4%. But because of this, we're very much still expected to have an interest rate increase at the next Bank of Canada meeting. And a lot of people are like, well, how's that even possible? How is inflation going down so rapidly? And we're still expected to raise rates. Shouldn't we be lowering rates or holding rates steady? That's what a lot of people are asking and curious about. And I just want to kind of walk you through this and explain why this is happening, okay? So on May 16th, inflation came in hot, 4.4%. Bond yields started to move up. And when bond yields move up, interest rates on the 5-year fixed product will move up as well. What a lot of people were expecting is that the Bank of Canada would hold here on June 7th. They would not raise interest rates because they would have another reading in just 20 days. So for example, June 7th is when the Bank of Canada was meeting, and then June 7th is when the Bank of Canada was meeting, and June 27th is when the next inflationary numbers were coming out. So many people were expecting that the bank would hold here and wait for this data to come out. However, the Bank of Canada surprised everyone, raised interest rates 0.25%, and caught everyone a little bit off guard, and the bond market moved up even more. The month of June was not a great month for interest rates because the bond market moved up quite a bit in the month of June. Actually, we hit its highest points in years. And that's really sparking 5-year fixed rates to be the highest levels they've been in quite some time. And that's why we're going to be talking about a little bit later about why this is likely going to affect the real estate market negatively as the cost to purchase is getting more expensive. So anyways, the Bank of Canada raised interest rates unexpectedly. And then June, May inflation numbers came out. So every month, the report behind comes out. So in June, we get May. In July, we'll get June. So on June 27th, the May inflation numbers came out, and it dropped 1%. It was a crazy drop, but it still actually wasn't in expectations with what economists were thinking and what the Bank of Canada was hoping for. Well, how are they expecting that 1% drop to 3.4%? And they're still expected to have rates go up. So we had a meaningful drop in inflation, but interest rates are expected to go up, and this was in line with expectations. What's going to happen on July 7th? Well, many people believe we're expected to go to 5%, and I'm going to show you why that's likely going to be the case. All we have to do is look back here and to kind of see what's going on. So here we have our 3.4% CPI data in May of 2023. Well, if we go to May of 2022, we could see that we were at one of our highest points of inflation. We were at 7.7%. So the way inflation works is that we're reading compared to our previous year's numbers. So a lot of people were expecting inflation to be low in the month of May because last May in 2022, we had one of the highest readings possible. So what's going to happen in the next month for June, we had the absolute highest reading. So that means inflation is going to come down by accident because we're comparing to high inflation numbers from the previous year. So what the Bank of Canada is worried about is that if they don't raise interest rates now and get ahead and slow down consumer demand even more, they fear that inflation is going to get out of control again and start inching up because in the months following, so in July, August, September, we're now going to be comparing 2023 inflation data to lower 2022 inflation data. So that's naturally going to potentially create more inflation, quote unquote, on the headline CPI data. So that's why they're being overly cautious here, raising rates, making sure that when we're comparing inflation to the previous years, that there's not going to be a huge increase in inflation and everyone's going to be in a panic mode again. So even though we had a meaningful drop, I understand what their plan is here and why they're looking to raise interest rates. They want to cool demand further. They want to make sure that people are curbing their spending. Supply chains are going to ease up. I'm not agreeing with everything they're doing, but I understand their logic behind the move here. So that's kind of like what's happening with inflation rates, in my opinion, on why they're doing what they're doing and why we expect inflation and why they expect interest rates to go up, because they still want to cool demand and they do want to get down to this target zone of 3 to 2% here. Okay, so that's just a high level overview. So let's quickly take a look at what that's going to do to the real estate market and interest rates. All right, so continuing on with what's going to go happen with interest rates, as we can see here, this is the 1-day chart. Let's go to the 6-month chart on the bond yields and see exactly what happened. As we can see here, the month of June was not friendly to the real estate market as we hit our absolute peak at 3.85% on June 22nd. We are seeing a little bit of relief here. We're dropping down. You know, we had that positive economic inflation report come out, and then it looks like inflation is just poking down a little bit, but I'm not sure if it's going to make enough of a move down to lower interest rates. Interest rates have gone up recently to be in alignment with the spread that's required for the banks to feel comfortable. So that's essentially what's going on there, and we're going to dive deeper into that. And then we could look at exactly what's happening with the mortgage, with inflation, sorry. And funny enough, that the biggest cause of inflation right now is mortgage interest rates and rent. So when you actually take out the mortgage costs, which I highlighted for you right here, and I'm going to zoom in for you a little bit. This is from the Globe and Mail. Excluding mortgage interest costs, the CPI rose 2.5% annually in May, down from 3.7% in April. So just think about this for a second. If they stopped raising interest rates, our inflation numbers would be at 2.5%, which would be right within their target zone. But because of mortgage interest rates being such a big contributor to inflation, that's essentially putting us out of the target zone. So it's kind of an interesting predicament to be in. So on the one hand, they're raising interest rates to cool demand, but on the other hand, they're by raising interest rates, they're making rent and interest on mortgages more expensive, which is included in the inflation readings. So essentially, they're causing their own inflation by raising interest rates. So it's an interesting dilemma to be in. And again, you know, I'm not sitting at the Bank of Canada. I'm not making these decisions, but you'd have to think that they have to be taking this into consideration when looking at making future rate hikes in the future. At the end of the day, when they raise rates, it's going to make mortgages more expensive. And if the bond yield goes up, it's going to make the 5-year fix more expensive, which will have a cooling effect on the real estate market, even with inventory suppressed. Well, I hope that this helped you kind of understand what's going on. Now let's kind of understand what happened in June and then put a predictive quality on what's going to happen in Q3 of 2023. All right, here we go. Okay, so to kick off with the interest rates, I always love doing this first. So as you can see here, I just pulled out the lowest interest rates possible that our lenders offer. I always use our lenders' lowest rates because it usually beats the market rate. So if you are looking for a mortgage, please reach out to us. We'll get you connected. Anyways, so right now, the best 5-year fixed product we can get our hands on is 5.09%. With the bond yields being at 3.67% as of closing Friday, we see a spread of 1.42%. So that spread is in alignment with what they're looking for. Usually when we have a 1.5% spread, the interest rate will hold. I'm hoping that the 5-year bond yield will continue to come down with some positive news. And then from there, we should hopefully get that interest rate under 5%. As you can see here, we had the best interest rates back in May at 4.29% when bond yields were around 2.9%. And that's because, you know, we had the lowest 5-year bond yield rate in quite some time in February, March, which allowed interest rates to continue to fall. And they were getting that comfortable spread right around the 1.5 to 1.4%. But now that bond yields are going up again, you can see that that's putting upward pressure on the 5-year fixed product here to 5.09%. Some other things that happened because of the interest rate increase. So as you can see here, the Bank of Canada key lending rate went from 4.5% to 4.75%. So that pushed the prime rate banks offer to 6.95% from 6.7%. So if you can get a really good discount on your variable rate, so the best discounted rate right now is prime minus 1.15%. And if you can get a prime minus 1.15%, you can get a variable rate mortgage for 5.8%. So at the end of the day, it's your decision on what you want to do. If you go for a variable rate, if the Bank of Canada does decide to lower rates, you will immediately get that benefit so long as the banks pass that off. And if you're looking for a fixed mortgage rate, the best you're going to be doing right now is 5.09%. Okay, so that covers interest rates.
Okay, with interest rates covered, let's see what's on the real estate market. So our 5-year average in July is 276 units on the market. Currently, we only have 225 units, so we're a 23% lower than our typical inventory. So inventory is still down. On top of that, we have 20 conditional sales, so net inventory is 205 units. So there's a couple things to take away here. Again, we're definitely recovering. If you look at this graph right here, we are recovering our inventory. We're approaching our 5-year average. We are definitely still down from last year's inventory and still well above 2021's. So we're finally on our way back to that average there. Interesting note, and here's a cooling indicator of the real estate market. This is definitely the lowest conditional rate we've had. So how many homes are pending or conditional for sale? Only at 9% conditional rate right now. So that's down quite a bit. So it looks like a lead indicator that the market is cooling. All right, so that's what's currently on the market. And now let's take a look at the inflow of the real estate market. As you can see here, we had almost a 4% lower inflow rate than our typical 5-year average, but that's still a massive improvement of what's been happening this year. For the majority of the year, we've had at least 20 to 30% less inventory coming to the market, hence the lower inventory rate. But it looks like we're starting to recover because we are getting some decent inflow on the month of June. So it's our best month of inflow we've had all year long. And that brings our total inflow number down 20 to 22% from our 5-year average. So inflow is still down considerably for the whole year. On the outflow side, sales were down 14.88% from our typical 5-year average. So again, still less sales are happening in the market. We're selling about 6.2 homes per day. So on a sales basis, we have 21% less sales. So 21.43% less inventory, 21% less sales. So really the inventory and the sales are in sync together. So it's not like we're getting a ton of inventory flowing to the market and then no sales are happening. So they are in sync, which is why this real estate market, even with less sales than usual, is staying balanced and even slightly tilting to the seller side. Even though I believe that's going to be changing in the next quarter, it was definitely tilted in the seller's favor in the months of May and June. Okay, so let's take a look at the failed sales and how many homes failed to sell. Here's another indicator that the market is starting to cool a bit. We had the most failed sales in the month of June at 81. We're still lower than our 5-year average, which is still a positive, but we had 2.7 homes fail to sell per day, which is the highest we've had all year. So another little indicator that the market is starting to slow down. Okay. Here's an indicator that looks like the market's heating up. The average days on market is 14 days. I think it's just an overflow of what was happening in May. Really a lot of activity coming in. There's a lot of people coming in and buying up the inventory. June was still a strong month, but there's some inclinations that the market is starting to cool off a bit. And this isn't one of them here, obviously. But let's take a look at the quarterly days on market. So we went from 29 to 21 to 16. So yes, there is a positive trend in the real estate market. I've been talking about it since Q4 of 2022. I was like, if you are in the real estate market, now is the time to buy. I said that in Q4 of 2022, and then the real estate market definitely picked up in Q2 of 2023. We had a significant drop in days on market, and we had, just going over the quarterly reports real quick, a significant increase in list price to sale price ratio. And then we had a significant increase in average sale price. As we can see here, the average sale price ended in Q2 at $862,000, up 14% from the previous quarter. And that previous quarter was up almost 2% or 1.5% from the quarter before that. So this right here is when I was telling people to start buying here. So taking a look at the monthly average sale price here, let's go into the monthlies now. And I want to show you that there is a little indication here again that the market's slowing. So we dropped to 877,000. We had, well, it's still 3 really strong months. Q2 is a really strong month for the real estate market. And because the inflation was coming down and because the bond yields hit their lowest levels in almost 2 years, that definitely drove a lot of buyer demand. There was a lack of inventory coming to the market. That lack of inventory also then created more buying pressure as well. So Q2 just had a lot of perfect storm formula happening for the real estate market to increase. With what's happening right now in the macroeconomic environment, interest rates have gone up. Inventory is starting to tick back up, even though we're not reaching our 5-year levels yet. I do believe that Q3, it's going to see this come back down to around the $850,000 mark. I don't think we're falling off a cliff or anything like that. We still don't have a ton of inventory. 5% fixed rates aren't the end of the world. There's a lot of people back in the day, historically speaking, that were paying 5% interest rates. So again, this isn't a doom and gloom scenario. I really just believe, like I've been saying since the beginning of these reports, is that we're going to have a 2018 kind of year, which is a nice, simple, flat year, and we're going to see some balance in the market. So I really do believe there's going to be some balance coming in the market in Q3. Only time will tell if I was right or wrong here. So some other things I wanted to show you quick. Quick is right here. Here's the overall picture of what's going on in the real estate market in 2023. So we do only have 1,400 units come to the market. That's 21% down from our 5-year average. We've sold not even 1,000 homes yet this year. That's 20% down from our 5-year average, and 19% down from last year, which seen one of the lowest sales ever. And I'm going to actually show you that report in a little bit here in the comparison report. We had the fewest homes sell. Sorry, let me just go to the outflow here. Listing outflow, sold listings. So last year we only sold 1,961 homes. As you can see with all these numbers, that is the lowest number we've ever sold since, what was that, 2014. So quite some time ago. And we are 20% lower than we were that year. So it's really looking like it's going to be a low amount of sales in 2023, even though the average sale price is going up, days of market are going down. It's kind of unpredictable here what's happening, but you know, it just looks like that the real estate market needs more inventory, and now with inflation happening, it's going to probably cool that down a little bit further. So anyways, it looks like we're going to have a low amount of unit sales here in 2023 because we're 20% down from last year, which was our lowest year. Let's go over here back to the comparison inflow report. Here we go. Okay, sorry, I deviated there, went down a rabbit hole. So as you can see here, we're significantly down in our unit sales, but they were picking up definitely. And I'll just jump back into here and show you that. Whatever, right? We're having fun here, so let's keep it going. 6.2 homes a day, which is less than May, but it's still the second best month of sales we've had. So yeah, definitely the amount of sales happening is increasing. It's just not going at a phenomenal clip or anything like that, which is good because there's no inventory. So there you go. All right, going back to the inflow report. So 1,500 units in, 1,000 out. Year to date, only 370 homes failed to sell. So there was a point last year, and I'll show you again, that this line, which represents failed sales, the blue line here, was actually higher than the sold listings. So it's, again, we're still having a really good year compared to last year. The failed sales are staying low. From the red line, which is the outflow, the majority of the outflow is being made up of actual sales, not failed sales, which is great. And as we can see here, we're getting more inventory coming to the market, which is desperately needed because this light gray line represents existing inventory level, and this dark gray line represents the 5-year average. And here we are in July. So we do need more inventory to recover. I really want to see our inventory get back to the 5-year averages. And if everything kind of stays the same right now, and this next interest rate hike that's potentially coming on July 7th, I believe it's July 7th, yeah. If that happens, I do believe that's going to be probably a pause from there on to see what happens. We're going to be, I think the bank's going to be waiting for more data. And hopefully that just levels out the real estate market here, and we get to a balanced market where people are shopping and people are selling, and there's not crazy stress in the real estate market. But that's to be determined. But anyways, this is a very positive sign that failed sales. We don't have those fake sellers on the market anymore that are just trying to sell their house for $10 million when it's worth $1 million. So those are kind of gone these days, which is nice. Net units added to the market. So we've added 68 units to the market so far, which is, you know, not phenomenal, but it's still pretty good that we're adding inventory to the market because obviously we're in lower levels here. So to do an analysis on like what type of market we're in, it's an absorption analysis that I do. And if we look at today's inventory of 225 units, and if we add 10.3 homes to the market a day, which is what the current inflow rate is, that's going to bring an additional 308 units to the market next month. So that's going to give us a total of 533 homes to consume in the next 30 days. And then if we sell 6.2 homes a day, that's going to take out 187 homes. So if that happens and no homes fail to sell, which obviously this doesn't take into consideration fail to sell homes, which there will be. But if there's no homes that fail to sell, there'll be essentially 346 units on the market for people to buy. And if we take the sold rate of 6.2 homes a day, it'll essentially take almost 2 months to sell all the inventory if no new inventory came onto the market. That's called absorption rate. So around 2 to 3, we're looking at a balanced market. 2 is more of a seller's market. 1 is a hot seller's market. 3 to 4 is a buyer's market. So right now we're almost right in the middle here. So we're slight seller's market, but we're definitely trending towards a balanced rate. So that's exactly what's happening. So let's talk about what's potentially going to be happening in Q3.
All right, so that was definitely a little bit of a longer market report here. There was a lot to cover. There was a lot going on, and there's going to be a lot more happening in the coming months. So I'm going to do another mid-month report. I promise I'm going to do that because I know there's a lot going on. A lot of you are interested in hearing about what's going on in the real estate market. So to put a bow on this, as we can see, there's a little bit of uncertainty in the marketplace right now with what's going to be happening with interest rates. What's the next CPI data release going to do? And that's going to inform the Bank of Canada's decision on whether or not they're going to go above 5% or maybe just pause for a while. With bond yields going up, it looks like that's going to put more pressure on the 5-year fixed, but we can see based on some data coming out that the bond yield is starting to slightly ease down a little bit, which is going to leave the 5-year interest rate where it is, hopefully. Anyway, so with about a 5% fixed rate and interest rates going up a little bit, and uncertainty about the CPI data release that's coming out, I do believe that Q3 is going to see a softer real estate market than we saw in Q2. And that's not a bad thing. I mean, if we can end up around the $850,000 average sale price, we still had really tremendous, healthy growth, probably too much growth, actually, if we look at a typical 5 to 6% desired rate of return on real estate. We're still going to have a really strong growth rate compared to what happened in 2022. So the market's still performing really, really well. And what this market can look like for a buyer, I mean, you always want to buy when people are fearful and you want to potentially sell when people are greedy. Right now, there's some fear in the market. Probably average sale prices are likely going to be coming down. So if you are a buyer on the fence, I would be looking right now to see if there's any deals, any opportunities. You should be connecting with someone on the Zahnd team for sure if you're looking at finding one of those opportunities that would fit for you, and keep your eye out for a potential deal. Because if the real estate market's going to soften and the bond yields start going down a little bit, we're going to see some little bit of a decrease in the 5-year fix, which will give you a better purchasing opportunity right in the perfect storm. I know it's not easy to time the market, but this one kind of feels like it's going to be a couple good buying opportunities in the third quarter. And then if you're a seller, at the end of the day, if you're swapping within the market, there's not really a perfect time to buy or sell. As the real estate market softens a little bit, it's definitely going to ease your cost of selling. Commissions will be lower, the land transfer taxes will be lower, et cetera, versus waiting till the prices go up. So if you are sitting on an asset and you're looking at swapping, it's still a great time to swap, upgrade, downsize, anything like that. If you're looking just to completely exit the real estate market, I mean, it is unpredictable what the next 3, 5, 6 months is going to bring. So right now we did have a really, really nice recovery from the absolute lows that we saw in Q1, Q4 2022. So if you are looking at selling, you could wait and hope for the best that the real estate market's going to recover. But if you need to cash out and you don't want to take the risk, I mean, the market did recover nicely from the lows, so you aren't losing quote unquote from the very tip top of the market that we had in April of 2022. So you still, if you bought in anywhere in the last 5 years, you still did tremendously well. And if you need to cash out, I wouldn't advise to wait to see what happens, because you never know. Inflation can go through the roof. That's really going to cool the real estate market. If you need your money out, I'd probably get it out sooner than later. Anyways, that's my analysis. I hope you enjoyed it. If you need any advice, please feel free to reach out to the Zahnd team. I always appreciate you guys checking this out. Thank you so much. We'll talk to you soon.